Good morning. Welcome to revision sessions at Bharadwaj. And here we start with section A. This is for not for new learners. You do not know the concept. You have not learned the concept at all. You do not have any material, or you have not learned the subject at all. You have not attended any class. You want to learn fresh. This session will not be useful. This is for those who have already completed learning. At the same time, they want to practice MCQs, like 100, 150 MCQs for each section. Then this revision session will be useful. So that is number one. Number two, let us start with revising. Let us go ahead with section A of part one. Part one, section A, not part two, because many students were asking, like when I posted a revision video, sir, is it for part two or part one, like that? This part one, section A. So let us go through the questions and let us go one by one. Integrated reporting is defined in IR framework as a process that results in periodic integrated report by an organization about what? Value creation over a period of time. So over a period of time, how the organization has created a value, that is what is reported in IR. Go to question number 2. Company reports on non-financial activities. In the section report, where it discusses activities that benefits, improves life of the people and communities where it is located, such as donating food pantries. It is which type of capital? Yes, it talks about communities, society, donating food pantries, all those things. It is part of which one? Social relationship capital. Corporate social responsibility focuses on impact on the organization, on the society. Impact of the organization that has on the society. Question number 4. Which one of the following statements regarding integrated report is correct? It contains only financial information. No. It should include material matters, both positive as well as what? Negative. Both positive as well as negative factors should be included. Correct. Next. The primary purpose of an integrated report is to explain how the organization creates, perceives, and erodes value over a time is called as what? Creates, preserves, and erodes value. Creates, preserves, and what? Erodes value. It is not human capital. Human capital will not erode. Intellectual capital, manufacturing capital, and all will not erode. It is actually financial capital providers. An integrated report should contain which of the following? Customer demographic is more like financial information. It's not going to contain competitive intelligence, risk, and which one? Opportunities. All the other information, A, B, D, are more like internal information, not an external information. Manufacturer keyboards incorporates non-financial information into analysis, reporting, and decision making. It is practicing incorporates non-financial information analysis, reporting, and which one? Decision making, which means they are integrating what? Non-financial information with what? Financial information. That is called as what? Integrated thinking, which is not an element of value creation, preservation, erosion process. Business model, outlook, external environment. External environment is nothing to do. Which is not an element. Organization's history. Organization, communication of organization history is not an element of which one? Value creation, preservation, or which one? I mean, erosion. Question number 9. The context of integrated thinking, reporting, value creation, preservation, erosion is
option B.
Value creation, preservation, and erosion. It talks about financial perspective, Daniel. So which one is correct? Therefore, B should be the correct answer. Increase or decrease or transformation of capitals caused by an organization, business, wealth, activities, inputs and outputs. That is the correct option. Yes. What is the first framework, earliest framework for that reporting social responsibility and sustainable development is which one? GRI, Global Reporting Initiative. So this question is about credit loss expenses. How much? 1.5% of credit sales. Credit loss expenses 1.5% of credit sales. We are estimating credit loss expense using accounts receivable by aging analysis. According to the relevant information is given, aging schedule is given to us, and estimated probabilities for each group is given to us. Probability of collection is given 0.98, 0.92, 0.75, 0.69. The balance is what? The possibility of bad debts. The possibility of which one? Bad debts. Total sales for the financial year is 65 lakhs, of which 85% was on credit. The allowance for credit loss had a credit balance of how much? 76,500 on December 1, 2023 given. Debit balance 3,400 on November 30, 2024 is given before any entry to the credit loss expenses made for the current fiscal year. They ask you to find out balance in which one? Allowance for credit loss after adjustment on November 30, 2024. They ask you the ending balance of the provision. Try to work. Do they ask you amount to be charged in P&L account or ending balance? Ending balance. Simple. What is the probability of not collection? 0.02. Multiply 0.02 into 6,40,000. 12,800. Then
14,000.
What is it? 0.08 multiply. How much you get?
14,000.
14,400. Then
0.25.
0.25.
23,700.
23,750. 0.6 now 0.4. 0.4 you multiply. How much you get? 16,000. What is the total of all these things? What is the total of all these things? $12,800, 14,400, 23,750, 66. 66,950 is the ending balance. Apart from that, we had a debit balance of 3,400. It is given. So that has to be offset. That has to be offset. So we have to adjust that loss also. What is the total provision required? 70,000 should be the option. 66,950 is based on the aging schedule. plus 3,400 to net off the debit balance. So closing balance required would be how much? 70,350. Shall we? Which option is correct? B. Same question. They ask you to find out how much is the credit loss expense. They don't ask you the closing provision. They ask you to find out what is the credit loss expense for the current financial year. 66,950. Check. Let me check. Think. Not 66,950. 66,950 is nothing but what? Estimated loss at the end of the year. What was the allowance at the beginning? What was allowance at the beginning? 76,500. This is a provision created. Apart from that, there is a debit balance. What is the debit balance on 30th November? 3,400. Maybe if you want me to prepare an account style, allowance will have a credit balance. What is the credit balance? And in the closing, we have got a debit balance, two balance carried down. No. Buy balance carried down, closing balance. Debit balance will come in the opposite side, right? So what is the closing balance given? 3,400 is the closing balance. So how much would have been written off? How much would have been written off to P&L? We had 76,500, opening balance debit, closing balance credit, closing balance became what? Debit. So how much would have been written off? How much would have been written off? Simple. I repeat. What is the provision opening balance? What is the provision opening balance? 76,500. Closing balance, it's given as debit balance. How much? 3,400. So how much would have been written off during the year or expense during the year? 79,000. 79,900. That is the answer. But option A here. Let me check the answer. 79,900 is the answer. The correct answer is what? 79,900 is the answer, not 79,470. This is not the answer. Answer is what? 79,900. Otherwise, you had a provision of 76,500. Closing balance, it became what? A debit balance now, which means we have written off how much? 79,900 in which expense in P&L. You have recognized an expense of 79,900 in the P&L. Next formula. The value of accounts receivable written off by the corporation during the fiscal year is how much they have written off. I hope the same answer should come. Opening provision 76,500 is there. Closing balance became debit balance. How much they would have written off? 79,900 they would have written off. 79,900 they would have written off. The opening balance credit. That's debit balance means this much would have been written off in P&L. This much would have been written off in which account? P&L. Both are same. The user's current expected credit loss model for valuing accounts receivable and it is making annual adjustments in the financial year end. November 30, credit losses are estimated based on all available information, including past experience, etc. Total sales is given to us. Total sales is given to us. All of them are credit sales. This. $10,000 loss that will write off in P&L account before the year-end adjustments are made. Account balances on November 30 prior to any adjustments 10,000 written off in Kuturka. Sales, accounts receivable, sales discount, allowance for credit losses, sales, returns and allowances are given. They have given which one? Credit loss, expenses are given to us. They indicate that 1.5% of net credit sales will be which one? Credit losses in Kuturka. They asked you to find out the allowance for credit loss. Okay, will it increase or decrease? Try to. Total sales 18 lakhs. How the 1.5% valuation is 1.5% of credit loss. So, what is the sales discount, allowance for credit losses, sales returns, and the allowances? Can you tell me what is the net sales? 18 lakhs minus what all you will adjust? Discounts 1,25,000 and the returns 1,75,000. What is the net sales? 15 lakhs. 15 lakhs into how much percentage? 15 lakhs into 1.5%. $22,500. So this will increase by 22,500. This will increase by how much? 22,500. This will increase by 22,500. Same question. Same question. They've given 3,90,000 with 1% loss, 1,15,000 with 5% loss, 2,10,000 with what? 15% loss and 25% with what? 40% loss. Can you tell me what is the provision that is required?
$51,000.
51,000.
3,900, 5,750, 31,500.
51,150. Now let us check the answer. What was the opening provision? 16,500 opening provision is there. In that some 10,000 is written now. So what is the correct answer? Tell me. We had opening provision. How much opening provision? In that, what is the credit loss? 10,000. Now? What is the balance opening balance? So eliminate this. Balance, how much it comes? 44,650. This is the loss to be provided in the current year. This is the loss to be provided in the current year. So where the journal entry with 44,650 comes? We have option B and what? Option D. It is an expense. This 44,650 is the expense for the current year. It is an expense for the current year. Expense you will debit or credit. Expenses you will debit. So debit credit loss expense for how much? 44,650 and credit the allowance for losses 44,650. Journal entry will be like credit loss expense account data 44,650 to allowance account 44,650. That is correct. Repeat. The closing provision required is 51,150. Opening provision after writing off the bad debts, net amount is how much? Net amount is how much? 6,500. So 44,650 is the expense that should be charged against which one? Credit loss allowance. Look at question number 16. They asked you to show the amount to be written off. Read the question fully, then we will solve. Simple. What is the opening balance? 4,700. We will add credit loss expense. What is the credit loss expense? What is the credit loss expense? 2,000. Then we will add bad debts recovered. What is the bad debts recovered? What is the bad debts recovered? 500. Then We will add amount written off. What is amount written off which we do not know? This will give us ending balance. What is ending balance given? Right. We're going to check the original question. What is ending balance? 5,000. So what is the difference? $4,700 plus 4,700 plus 2,500. What is the total you are getting? 7,200. Yeah. So far we get how much? 7,200 minus how much written off will give us ending balance? 2,000.
T method is solved.
T method is next question. Aging schedule is used to
Option B.
release the value of debtors. Read this question and try to solve. 1% predicts loss. Go through this. Tell me what is the provision to be created? Multiply and tell me. Direct law it's given. 7,30,000 into 1%, 40,000 into 6%, 18,000 into 9%. This into 25%. What is the total? Multiply and tell me the total. 7,30,000 into 1%, 40,000 into 6%, 18,000 into 9%, 72,000 into 25%. How much you are getting?
28,000.
Then apart from that, there is a debit balance of how much? 14,000 in the allowance. That also should be adjusted. That also should be adjusted. What is the total?
43,000.
Option B. Adjusting entry will be for 43,320. Look at the question. The balance and allowance for credit loss will be nothing but closing balance. Balance and allowance for credit loss after adjusting entry will be nothing but the closing balance. Closing balance already we worked out much. This 29,320. That is the provision required or ending balance 29,320. Directly A. They ask you the closing balance. Any doubt in this? Done. They ask you to find out balance and allowance for credit loss. Nothing but the closing balance. Here they ask you to find out the balance and allowance for credit loss. Now, how much provision to be maintained? Here they are asking you how much to be charged as expense. How much to be charged as which one? Expense. Okay. So that is what. Next part. Question number 20. Credit loss expense must be estimated to satisfy matching principle that excess are recorded in the same period or related to which one? Revenue. Under the current expected credit loss model, we estimate the allowance for credit loss for a period. What the companies do?
2% of the total accounts received.
Current expected credit loss method. Current expected credit loss method. To estimate the allowance for credit loss for a period, the companies, what do they do? This is one of the method. What do we do while charging in P&L account? What do we do while charging in P&L?
Percentage of
Is it accrued as a percentage of accounts receivable? How much we charge it in P&L account? Is it only this amount? Accrue either an amount based on a percentage of credit sales? No, it is not based on a percentage of credit sales. It is not just percentage of accounts receivable. It is not percentage of credit sales. We consider both. We consider both this one as well as what? As well as any change in the provision to be made. Any change in the provision to be made. The thing is the first one. Accrue forward looking estimate of expected credit loss when a financial asset is first recorded. Increase or decrease in the expected credit losses and the existing financial assets are transferred to P&L. Look at this. On the statement of financial position, how the accounts receivables are valued? Is it original cost, accounts payable, current market value? No. We work out which one? What is net realizable value? Accounts receivable minus credit losses.
proper margin of
Expected credit loss method of estimating credit loss. Expenses generally accepted principle is preference to direct write-off method because simple. Current year expenses are matched with what? Revenue. For example, how much you charge? Provision required plus what? The debit balance in the loss you charge it. The P&L. How much is cash collected paper? How much is cash collected is given. They ask you cash collection. They ask you which one? Cash collection. What is the credit loss expense for the period? 2,000 is given. Tell me the amounts. What is the credit sales? Okay. Credit sales 1 lakh. Then
2,000
increase in accounts receivable means which we have not collected the money with. Increase in accounts receivable means which we have not collected the money. It is not closing balance, it is accounts receivable. Increase in accounts receivable how much? 30,000 which we have not collected. And then how much is expense written up? What is the expense written up? 2,000 we have written up. So how much is collected? Others are like provisions. 68,000. Please remember this is not an ending balance. It is increase in accounts receivable. Which means to this extent we have not collected out of what? Credit sales. And apart from that we have written off credit loss expense of 2,000 means how much has been collected? 68,000 has been collected. See, we are not bothered about how much of credit loss, beginning balance, amount written off, ending balance, etc. Okay, so how much is collected than kettle? Okay, 68,000. Look at the next one. Woody Company sold 1,50,000 of the accounts receivable without recourse, which means we are factoring. We are factoring. The purchaser assessed a finance charge of how much? 5%. Assessed a finance charge of how much percentage? 5%. Which means it is like factor says 5% you will charge. So 1,50,000 into Woody will record. Okay. It is not an interest expense. It is not an interest expense. It is factoring charge. We are not collecting cash. We are not collecting cash. Credit liability transfer to accounts receivable? No, there is no such thing. Credit the accounts receivable with what? It is like factor account debtor to accounts receivable account. Factor account debtor to what? Accounts receivable account. Accounts receivable will have what? Debit balance. We are transferring to the factor. So 1,50,000 will be credited to which one? Accounts receivable. That is a correct option. That 5% is not of interest expense. Read this. The question is, the entry to write off accounts receivable balance 10,000. We are writing off accounts receivable balance. We are writing off which one? Accounts receivable balance. Where it will be written off? Against the provision, against the provision, against the allowance for credit loss account. So, will it change your total assets? Writing off bad debts, will it change your total assets? No. Or will it change your net income? No. We are charging against provision only. We are charging against what? Provision only. So it will have no effect on total assets and which one? Net income.
The provision income statement.
One. For example, here while charging in P&L account or while charging in P&L account, okay, do we charge this 10,000 bad debts, etc.? No. Do we charge bad debts in P&L account? No. So this 10,000 will be charged in P&L account or allowance account? Allowance account. So it will not cause any change in the income. It will not cause any change in the income. Why? Because we are indicating 1.5% of net sales will be which one? Credit losses. We are estimating the loss based on which one? Credit sales, against which the amount will be written off. So this 10,000 will not affect your P&L. It is charged against allowance account. It is charged against what? Allowance account, not in the P&L. Otherwise, here how the bad debt losses are estimated as a percentage of credit sales. As a percentage of credit sales. Look at the next.
Balance sheet.
Allowance account will not get affected because of this written off amount. Because allowance account itself is created based on what? Allowance account is created based on what? As a percentage of credit sales. So writing off will not affect. Which of the following is true with respect to assignment of accounts receivable and factoring accounts receivable for a manufacturing firm? What is factoring for a manufacturing firm, Peter? Accounts receivable and factoring of accounts receivable for a manufacturing firm, they ask. Lender has recourse to manufacturing firm under factoring but not under assignment of accounts receivable. No such thing. Factoring of accounts receivable involves invoice from the manufacturing firm to its customer being stamped with the notification that the payment has to be made to the direct other party. That is true. Accounts receivable, when you factor, when you make an invoice, ensure that while sending the invoice, you make the payment to a third party. But if I just assign my data, invoice would have been already prepared. No such things are done when you assign the accounts receivable. What do you mean by factoring? I sell the goods, I inform the customer to make the money payment to the factor. What is assigning the accounts receivable? I transfer my data list to you, I get a payment. Now, while preparing invoice, etc., whether you would have informed the customer, no. Uncollected balances alone I transfer. Uncollected balances alone what I transfer. Inventory tracking methods. Beginning inventory 1050, the cost of 60,900. During the year 70,100 units were purchased at 7.5 using FIFO. Ending inventory value for 11,500 will be how much?
86.
How?
FIFO,
always latest inventory will be there. Always latest inventory will be there in the godown. 11,500 into 7. 11,500 into 7.5, much again? 86,000. 86,000 to 86,000 to 50. We want to go with perpetual inventory system. Which one of the following statement is correct in Gator? We want to go for perpetual inventory system. Perpetual inventory system requires daily reconciliation between goods sold, cash register. No, we are not going to compare cash register. Cost of implementing and administering perpetual inventory system would be probably exceed the savings. Perpetual inventory system might eliminate necessary have a physical. No. Perpetual inventory system, we have to take physical inventory. We have to take what? Physical inventory. Perpetual inventory system is cheaper. No. See, when you want to go for another method, from periodical method to which one? Perpetual method. Perpetual method is costly. What is perpetual method? Transaction basis you update. It is called as continuous stock taking. It is called as which one? Continuous stock taking. It will consume time. It will have more expense. It will have what? More expense. We have to check the benefit of going to which one? The perpetual inventory system versus cost of that particular system. Going for a perpetual inventory system will minimize the losses, loss of inventory, theft of inventory, etc. But cost is there. Cost is there. So, what is the correct answer? B is the correct answer. Because he's a small retailer. Next one. Which one of the statement affects disadvantages of LIFO inventory? Acceleration in income tax, no such thing. Current costs are matched with current revenue, no, that is matched. Latest inventory is only used. Negatively impact company's cash flow, it may be negative or positive. Normally, physical flow of inventory, how it will take place? First purchased, first sent. First purchased what? First sent, and not last purchased, first sent like that. LIFO method of cost flow assumption. The financial statements are given. Current assets, total assets, current liability, retained earnings are given. Income tax, etc. is given. Net income, dividends are paid given. Inventories are valued using which one? They want to go for LIFO. Okay? FIFO assumptions. If FIFO cost of flow assumption is used, inventory would be how much? 100, 103, 103. Lower than reported in December. If they would have, company had used LIFO during the last 3 years. Think on that and work. It's based on whether inventory value will be low or high. If you would have followed LIFO method, inventory will have what? Lower value. For 2000, 2001, 2002 is given. If they would have used LIFO during the last 3 years, what would have happened? Current assets would have been 10611. What is the current assets? 994. What is the current asset? 994. If you would have followed LIFO method, inventory value is low. Inventory value is what? Low. Which means current assets would have decreased or increased. Current assets would have decreased. So this is not an option. Cash available for dividend would have increased by 36. Look at. What is the dividend distribution ratio, Parag? What is the dividend distribution ratio? 87 divided by 221 for
39%.
30? Last year, 83 divided by 223.
$37.
78 by 208.
37.
What is the current year dividend declared? What is the current year dividend that is declared? No, what is 87 divided by 221? 87 divided by 220. 39 point.
39.36.
What are you?
Let it know from your relation of the dividend percentage.
The inventory value would have been lower by how much? 103. If ending inventory is low by 103, if ending inventory is low by what? 103, what would be the impact on profit? What would have been the impact on profit? What would have been the impact on profit? Profit would go down or go up? Net income 221. Okay. But beginning inventory also changed by the same amount. Yeah, beginning inventory is also changed by the same amount. No, this is not an option. This is also not an option. Leave it. Next. In the period of rising cost, which of the inventory cost flow assumptions will result in higher cost of sales? When prices are increasing, latest first output of the higher cost of sales will happen. So which one will happen? Last in first out. Last in first out. The advantage of last in first out inventory method is based on the assumption that most recent cost incurred should be allocated to which one? Cost of goods sold. Correct. The operations of the firm may be viewed as annual series of transactions as a series of separate ventures. The inventory valuation method that views a firm as a series of separate ventures is specific identification. We identify specifically and do it. FOB destination is given. FOB destination is given. Shipped 80,210. These goods are scheduled to reach various retailers at the end of December. The merchandise inventory total how much? Merchandise inventory total how much? 24,57,820 for the wholesaler before adjusting entries. The wholesaler is expecting 75,330 incoming shipment that was sent on FOB shipping point that Larry 1 January 2 கொடுத்திருக்காங்க. It is sent on December 30 itself.
So it is 24.
For the existing inventory, it was determined that 20,450 of the goods are obsolete, cannot be sold in the. So what will you do?
Inventory total plus 75,330 minus 20,000.
Now, what do you mean by FOB destination? What do you mean by FOB destination? Our risk is over only when the goods are reaching the destination. Goods are reaching the destination. This happened on 80,720. So wait, we are a seller. We are a seller. This will be included in seller's inventory or buyer's inventory. As on 31st December, whether the goods have reached the destination? No. This will be included in whose inventory? Seller's inventory only, because it has not reached the destination. Apart from that, we have got inventory worth how much? 24,73,520. So this should be included. This should also be included. This should also be included. Why? We are getting an incoming shipment which was sent on FOB shipping point, which means with respect to the other seller, his job is over when it is put in the course of transmission, which means December 30 itself, his job is over. It will be included in our inventory. Why? We are buying it. We are buying it. Obsolete inventories will be eliminated. Work out and tell me the inventory. So 80,210, has it reached your people? Has it reached your people? No. It is part of your inventory. 24,57,820 physical inventory. We are buying an inventory with FOB shipping point means already a shipped. That should be included in our inventory. Obsolete inventory should be eliminated. Should be like 80,210. Plus 2, 4, 5, 7, 8, 20 plus 75, 330 minus 2440. How much you get?
25,22,000.
See. Any doubt in it? We sent but not delivered. Till delivery, we are responsible. So our inventory. This is also our inventory. We purchased, okay, it is put into the course of transmission, FOB shipping point. So it is our inventory. Obsolete goods will be eliminated. First, last in, first out. Last in, first out. Perpetual. Please remember LIFO, perpetual. See, out of this, 190 units should have been sold. The balance will be what? 10 units. 10 units into 10. We purchased 150 units at the rate of 12 and sold what? 120 units. Now, LIFO, perpetual. LIFO, perpetual. In the 150, 120 would have been issued. LIFO. So, balance over 30 will be there in this. So, when you work out, the opening stock is there 100 into 10 plus out of 200, 190 would have been issued 10 into 10. 10 into 10. Out of the 150, 120 is issued. Balance will be 30 into 12. Right? So perpetual. 150 out of that, 120 is issued. 200 out of that, 190 is issued. What is the answer? 1460. If it is LIFO periodic, என்ன பண்ணிருப்பீங்க? If it had been LIFO periodic, what would have done?
Ending inventory into 10.
What is ending inventory? We'll see. I hope the same question gets repeated. The company uses first in, first out method. The company uses first in, first out method. So simple. Out of this 300, 190 is issued. Now balance will be 110. 110. Again, we purchased how much? 110 will be there at the rate of 10. At the rate of 10, it will be there. Again, we purchased how much? 150 into 12 we purchased. While issuing this 120, we would have done. Out of this, we would have taken 110. Balance 10 we would have taken out of this. So balance will be 140 into 12. What is 140 into 12? 1680. Right? So 1680. Then perpetual inventory system. This is which one? same. Oh, questions are different. Okay. So perpetual system. Total of 360 la 180 has been issued. 360 la 180 has been issued. Now balance will be 360 la 180 has been issued. Now balance will be 180 units. How will you value it? 180 into 20 will be there. Again, we purchased how much? 140 units we purchased. We sold how much? 100 units now. Before it, we'll adjust this one. Minus 100 per. So balance will be like that 80 into 20 plus this 140 purchased is not issued into 20. 80 into 20 because before method, you know. So 360 minus 180, 180 stock is there. When you issue that 100 is adjusted. So balance 80 into 20 plus this into 24. What is your answer? 4,960. 4,960. Try to work out moving average cost. At this point, what is average cost? 360 units into what? 20. How much it would have been? 360 into 20, how much would have been? 7,200. Then issue பண்ணும்போது 180 into 20 will be 3,600. Balance இருக்கும். Okay. Balance would be like 180 into 20. Of course, 3,600 will be there. We will add what? We will add that 140 units into 24. 3,000. Now, what is the weighted average cost? Total of 220 units. Sorry, 320 units. 320 units. The value, what is the value of the 320 units? 6,960. What is the average cost? 21.7. So 21.75. Again, we are issuing how many units? So less 100 units into 21.7. 21.75. How much it would have been? 2175. 2175. Balance will be how many units? 220 units. Balance 6960 minus 2175. Minus 2175. What could be the answer? 4785. Perpetual inventory system. We use last in first out method. The value of inventory would be simple to work out. Perpetual last in first out. The sales 180 units would have been out of this 160. Balance 20 out of this. So stock will be like how much? 180 into 20. That will be there. 3,600 will be there. Then out of this 140 purchase units, sales 100 is made now. Balance will be how much? 40 units into 24. 40 units into 24. How much will it?
960.
How much?
960.
So this stock will be there. And this stock also will be there.
4560.
Answer is D. 4560. 4560. Opening balance is given here 150 at the rate of 4. We are selling for 7, that doesn't matter. We are following which one? FIFO inventory pricing. What is the value of inventory category? See, let it be perpetual or periodical, it will give the same answer with respect to FIFO. What is the total quantity available? 150 plus 200 plus 200 plus 250. What is the total quantity?
Option B.
Total quantity is 800. What is sold out quantity? 100, 150 to 20, 100. 100, 150 to 20, 100. What is the quantity sold out? 570. 570. Balance. Balance how much? 230 will be valued at latest price. Before method old stock goes up, latest price it will be there at the rate of 4.80. Latest purchase was 250 at the rate of 4.8. So 230 into 4.8, what is the answer? 1104. Same question. They ask you to, they are following which method? Periodic weighted average. Periodic weighted average. Simple. Multiply all the things available. 150 into 7. Sorry, 150 into 4. 150 into 4. 200 into 4.2. 200 into 4.4. And 250 into 4.8. Okay. That divided by total quantity. Just let us work out. Simple. 150 into 4 plus 200 into 4.2 plus 200 into 4.4 plus 250 into what? 4.8. This is divided by total quantity. What is the total quantity? Total quantity we worked 800 units. This will give us weighted average cost. Okay, do this divided by total quantity. Follow. Total divided by total quantity total. Total divided by total quantity. How much you get? 3,520 divided by 800. How much you get? 4.4. So 4.4, using that, let us value the ending inventory. 4.4 is the value. So 4.4 into 230 will give us value. 4.4 into 230. Total cost divided by total quantity 4.4 into 230. What is the answer? 10. So 1012 earlier. Simple. What is the sales? They ask you to find out gross profit. Sales is how many units we sold? 570 units we sold. 570 units we sold at the rate of 7. It is given. 570 into 7, how much you get? The question is not about ending inventory, gross profit. 570 into 7. Less cost. 570 into 7. What is the cost? 570 into 4.4. What is the cost? 2508. That is the cost. So balance will give us gross profit. 3990 minus 2508. 148. Option is C. They ask you to use which one? Same question. LIFO periodic. LIFO periodic. What is the closing inventory? What is ending inventory value? What is the ending inventory value? I hope 230 units will be valued at LIFO method. What would have been the ending inventory value? Based on the latest price. LIFO latest price oldest price. A LIFO method when you follow, ending inventory will be at what? Oldest price. It will be at what price? Oldest price. Last and first out. Ending inventory 230. It will have first 150 at the rate of 4 plus balance 80 will be at the rate of 4.2. What is ending inventory? 230. Old stock will be there in the godown. What was the oldest stock? This 150 at the rate of 4. Out of 230, oldest stock is how much? 150 at the rate of 4. Now balance 80 will be at the rate of 4.2. So what is the ending inventory value? What is ending inventory value? 936. Wait பண்ணுங்க. What is the total cost of inventory? We worked out. What is the total cost of inventory? Multiply பண்ணுங்க. 150 into 4, 200 into 4.2, 200 into 4.4, 200 into 4. We multiplied. How much? 3520. In the 3520, ending inventory is 936 now. Ending inventory is how much? 936 now. What will be the cost of goods sold? 3520 minus 936. Ending inventory will give us cost of goods sold. How much?
258.
So what I request is, those who are accessing recording also, try to work out the next 4 questions. Which question number? 43, 44, 45, 46, 47 வரைக்கும் try பண்ணுங்க. இதே model problem தான். But understand the question and try to work. For those who are accessing recording, ensure to pause the lecture. Try to work out from 43. What is 43 question? Using perpetual LIFO inventory pricing, what is the closing balance of inventory? What is the closing balance of inventory they ask for? Weighted average, periodic weighted average. They ask you to find out gross profit. Moving average inventory pricing in the sale of 228 items. November 16th, what will happen like that? They would have asked for. Try to work out up to 47. Try to work out up to 47. Try பண்ணுங்க. Then I'll take your answer. Start. Shall we? They ask you to find out which one? Value of inventory at the end of the year. Which method? LIFO. Okay. If you look at how many units are sold? 100 units are sold. Could have been out of the opening balance. Balance, how much will continue? Balance will continue 50 at the rate of 4 will continue. Then 200 we purchased. 200 we purchased. When you sell them perpetual, so 150 is sold out of that. Balance, how much will continue? 50 into 4.2. 50 into 4.2. 50 into 4.2. We purchased 200 and sold 220, which means balance 20 would have been sold out of this. Out of this 50, balance 20 would have been sold. Balance will be how much? After this, balance will be how much? 30 into 4.2. 30 into 4.2. Why? Because this 4.4 would have been sold. Balance we would have touched from the previous balance. So this 30 into 4.2 will be there. How much we purchased? 250 we purchased. In that we sold what? 100. Now balance will be 150 into 4.8. 150 into 4.8. So just add these things. 50 into 4 continues. In that 50, 30, 20 is sold, now this continues, and this 150 into 4.8 will be there. What is the value of inventory? 50 into 4, 30 into 4.2, and 150 into 4.8. How much? 1046. 1046. 1046. Periodic inventory pricing. This already we have done earlier. 1482. Periodic weighted average pricing. What is periodic weighted average pricing? Oh no, this is a different question. Periodic weighted average pricing, just multiply all the units that are available. 150 into 2 plus 200 into 2.1 plus 200 into 2.2 plus 250 into 2.4. This will give us total cost divided by total quantity. Tell me. 300, 420, 440. Total 1716 divided by what is the total quantity? 900. How much? 2.2. So using this, they ask you the gross profit. Work out which one? Gross profit. So what is the sales? What is the sales? What is the sales? 100 plus 150 plus 220 plus 100. 100 plus 150 plus 220 plus 100. What is the total? 570 into 3.5. 570 into 3.5. How much you get? 199. Cost 570 into what is the thing we got? Cost 2.2. 12. What is the gross profit? 1254. What is the gross profit? What is the gross profit? 741. Gross profit is 741. Answer is what? A. Next. The same question. The sale of 220 items on November 16th will be recorded at. They are using moving average inventory pricing. This, what is the cost for this 220 kg? We have to work out which one, moving average method. So simple, we have redo it. There is no other go. 150 into what is the price? 150 into price to adle 100 actually. 50 into 2. 50 into 2 will be how much? 100. Any doubt in it? Out of the 150, 100 is sold, balance 50 into 200. Again, we are buying 200 into 2.1. 200 into 2.1 will be 420. So, what is the total cost? For 250 units, what is the total cost? The value is how much? 520. Okay, what is the average? What is the average? 520 divided by 250, what is the average? 2.08. In that, what is issued? 150 is issued. 150 units are issued at the rate of 2.08. 150 into 2.08 will be 150 into 2.08 will be 312. Balance. What is the balance? 250 minus 150, 100. 520 minus 312, 208 will be there. And we purchased. How much we purchased? 200 into 2.2. 200 into 2.2. 200 into 2.2, how much? 440. So what is the total? 100 plus 200, how many units? 300 units. Okay, total 208 plus 440. 208 plus 440 648. So what is the average price for this? 648 divided by 300. What is the average for this? 2.16. At this rate, we would have issued the next one. At this rate, we would have issued what? The next one. So answer is what? 2.16. Done. Next one. Perpetual which pricing? LIFO pricing. Value on November 30th they asked for. Inventory value on November 30th they asked for. LIFO method. LIFO perpetual. LIFO perpetual. So in this 150, 100 is issued. What will be the balance? 50 into 50 into 2. 50 into 2, 100 is there. Again, we purchased 200 and issued 150. Balance, same model we have done. 50 into, price not different. 50 into 2.1, 50 into 2.1. Then, this time, same question now. 200 we purchased, but 220 we are issuing now. The balance 20 will be out of this. The balance 20 would have been out of this. Balance will be how much? 30 into 2.1. Then again we purchased 250, issued 100 only. The balance will be how much? The balance will be how much? 150 into 2.4. 150 into 2.4. How much it will be? The 360. This one 50 into 2.1. Sorry, 30 into 2.1. 63. This one 100. 100 plus 63 plus 360. What is the answer? 523. A is the answer. LIFO perpetual. So this 360, 50 in the 20 is issued, 30 into 2.1. This 50 continues. So total how much you get? 523. They ask you to find out cost of goods sold. Periodic LIFO pricing. What is periodic LIFO pricing? Okay. What is the total quantity? What is the total quantity? 150 plus 200 plus 200 plus 250. What is it? 800. What is sold out quantity? 570. 570. What is the closing balance? 230. So will you value this? Latest price. Based on which one? Latest price. So 230 will be valued at the rate of what? What is the latest price? 2.4. What is it? 230 into 2.4. How much you get? 552 is the closing stock value. Already we worked out the total cost. For the same question, we worked out the total cost. This one. What is the total cost earlier we worked out? No, we have not done it. Oh, no. What is the total cost of this? What is the answer? We worked out. No? $3,520. Clear, the 4 rupees the value. So please rework. Please rework. What is the answer we are getting? 150 into 300, 420, 440. Add பண்ணுங்க. 17. So 1760 is the total value of the inventory. In that, the closing balance of inventory is 552, means balance is cost of goods sold. The balance is what? Cost of goods sold. 1760 minus 552. What is the answer you are getting? 1760 minus 552. 1, 2? No such option.
Minus how much, sir?
We made a mistake. We made a mistake. It is last in first total. For closing balance will be 230 units. It will be valued at no, not 2 rupees. 150 down 2 rupees. Closing balance is 230. While valuing, what you should have done? We'll take 150 into 2. 150 into 2. Balance 80 will be at the rate of what? 2.1. So what is the value of inventory? 150 into 2 plus 80 into 2.1. This is the value of closing ending inventory. Okay, LIFO. How much?
168.
168. So 1760 minus 168. What is the answer?
150. 268.
260?
460.
268. 300%.
468. 1760 minus 468. What is the answer? 1292. 1292. Next, which one of the following actions would result in decrease in income? Accelerating purchases at the end of the year when we use which method? Last in first out method when the prices are increasing. See, when the prices are increasing, when you use LIFO method, issues will be at a higher rate. Cost of production will be what? At a higher rate. So that, I mean, that will result in what? Decrease in income. That will decrease in income. What is the reason for not adopting equal is good to maximize cash flow? Valid reason for not to adopt LIFO method of inventory valuation is? What is the reason for not adopting? Price rising or falling?
Rising.
Now we want to maximize which one? Cash flow.
Last time first price వచ్చిన
So see, if the prices are increasing, what will happen? If the prices are increasing, LIFO method will result in okay. We want to maximize which one? Cash flow. We want to maximize cash flow. When prices are falling, what will happen?
More profit. Inventory value will be high.
LIFO method, the inventory value will be what? High, profit will be more. Profit will be what? More. But our objective is not to maximize which one? Profit. Our objective is to maximize which one? Cash flow. Okay. Simple. When prices are falling, when you follow the LIFO method, when you follow which method? LIFO method, latest first out. Up to the, you will be selling at lower price or higher price? Lower price. When you sell at lower price, the cash flow will come down. Cash flow will what? Come down. I repeat. Earlier the prices were high. Now the prices are reducing. When you follow LIFO method, latest inventory was purchased at $8. We market 20% and sell them. So old price would have been higher, latest price would have been more, lower. Selling price also would have been more, proportionately lower. So when there is a lower selling price at the end of there, it will result in which one? Reduction in cash flow. It will reduction in which one? Cash flow. So when the prices are falling, when the prices are falling, the cash flow will come down. Cash flow will what? Come down. That could be the reason. The goal is maximizing cash flow. When prices are falling, when you follow LIFO, what will happen? It will reduce the cash flow. That is the reason for not adopting LIFO. That is the reason for not adopting LIFO. 50 part. Weighted average periodic. 50 into 40 plus 100 into 45 plus 50 into 15. What is the total? How much?
9,000.
Divided by total books. 50 plus 100 plus 15. 200. What is the cost? 45 is the cost. So they asked you to find out year-end value. So 150 minus 80 minus 50 plus 60. What is the year-end inventory? Otherwise 130 is sold. 130 is sold. Now balance will be 70 into 45. 70 into 45. What is the answer? 70 into 45. What is the answer? 3,150. Early end answer. Check. Yes. Minus. This is plus. This is minus. What is the ending inventory? 60 into 45. 60 into 45. How much you get? Answer is B. The inventory method that will result as same inventory value in cost of goods sold when perpetual or periodical method is used is what? First in, first out, there will be no change between what? Perpetual and which one? Periodical system. In the period of rising prices, which one of the inventory method usually best matching expenses against what? Revenue. Which one? First in, first out. First in, first out. Read 53 and try. Wait for think what is it? In the period of rising prices, which one of the inventory method usually provides matching expenses against what? Revenue. I hope it should be LIFO. Latest price is sold, latest cost is sold at the latest price. Latest cost is sold at what? Latest price. So, matching expenses against revenue, which one method will give us the best? LIFO will give us the best. Read 53 and try. What is the opening balance? 1000. Valued at how much? 787,500. Again, we purchased 2000 for how much? 15,62,500. Again we purchased,
400.
okay, 400. Again we purchased how many units? Sales 2,400 units. Purchased another 2,000 units. At the rate of how much? 15,37,200. So what is the total quantity and total purchased? 5,000. For that, what is the total cost? 5,000. What is the total cost?
996.
Average is 57 point.
Okay, tell me the total.
100.
So what is the average? What is the average? 4, 2. This into closing stock.
2,600. Option is
Out of 5,000, we sold 2,400. Out of 5,000, we sold how much? 2,400. Now, the balance. Into 2,600. What is the answer? Yes. Okay. Wholesale manufacture of engine parts. We had inventory, sale prices are given. So simple. Total and work out these two. 3,200 plus 3,400. 3,200 plus 3,400. 3,200 plus 3,400. They asked you to find out cost of inventory. Okay. So 3,200 plus 3,400. How much on this date? 6,400. What is the value? What is the value at this time? 6,600. What is the value at this time? 3,200 into 64.3, 64.75. Multiply both. Add how much? Get?
average is 64.5.
Okay. Average is how much? 64.53. Then total cost is 100. That's better. Total 3,200 into 64.3, 3,400 into 64.7. 425. So average is this much. In that, how much is issued? 3,600 is issued. Okay, at the rate of this price. At the rate of this price. So no need to check again. Balance will be 3,000 units into 64.33 can do. How much you get? 3,600 into 64.53. What is it? 23. They asked to round off to the decimal places. Balance 3,000 units will be how much? This 425910 minus 232314. Work out and tell me. Balance will be
9360.
again we are buying. How many units we are buying? 3,500 into we are buying how much? 66. What is the thing? 3,500 into 66. Add panna. What is the total? 6,500 units will have a total value of 193,602. 193,602 plus this
1,24,600.
602. What is the average? 424,602 divided by 6,500. What is the average?
65.32.
65.32. And we issued how many units? 3,450 units. Balance will be 3050. We'll take it at 65.32. 3050 at the rate of 65.32. What is the value?
199.
199.
Double to 6.
Which is closer to this answer. Because of the decimals, there's a problem. Done. Read 55. Weighted average periodic inventory system. They asked you to find out total cost of inventory. From this itself, let us take the input. They ask you to work out by weighted averaging method. 6,600 units, this is the value. They don't ask moving average, weighted average. Again, we purchased 3,000 units. 3,500 units at what? 66. Total of 6,600 units are there. In that, again, we purchased the 3,500 units at the rate of 66. So, what is the total?
56,900.
Total will be like 10,100 units. Values
6569. 10.
1.
0.
So, what it is the average cost? 16. 65,65910 divided by 10,100. How much you get?
65.04.
0. 4 into closing inventory. What is the closing stock? Already we worked out the 3,050. Closing stock 3050 units.
198,270. Option
Option C. That is 3050 into 65.04. Option C. First in, first out perpetual inventory system. First in, first out perpetual inventory system. It's better to go with, it is better to go with periodical and perpetual will give us what? Same answer. Periodical. Oh, it will be a different one. Last in, first out. Then it will, the answer will be different. So, first we have two inventory. In the 3,400, we are selling 3,600 now. Balance how much? 200 would have been sold out of the previous one. Out of the 3,200, they would have sold this 200. First, latest 3,400 they would have sold. Balance they would have sold. What is the value on this date? What is the value on this date? 3,000 into 64.3. Then let us see. Again we are purchasing. 3,500 in the 3,450 only is sold now. Balance will be what? 50 into 66. Latest, last in, first out. Add these two, you will get the answer. Any doubt in it? In the 3,600, first the 3,400 would have been issued. Balance would have been taken out of the opening inventory. So 3,000 into 64.3 and this 50 into 66. What is the total? 1,96,000.
3,000 into 64.3.
Okay. Any doubt in it? First, In the 3000, balance 200 would have been which balance? Opening balance. So remaining balance would be 3000 into 64.3. Latest purchase is issued first. So 50 into 66. We get 1,96,200. 57%. They ask you to work out under which method? Periodic inventory method. Periodic inventory method. Periodic inventory method, very simple. What is the latest, or what is the stock? What is the stock? Closing stock?
3,000.
Closing stock is how much?
3,000.
3050. If it is periodic, latest inventory. What is the latest inventory price? What is the latest inventory price? 3050 into 66. We have 3050 units. Latest inventory purchase was 3500 into 66. So out of this 3500 only, this latest stock will be there. We take it at what? 66. What is the answer?
The price on 64. Last thing first.
Oh, sorry. Yeah. Correct. 64 the number. Sorry, it's not FIFO, it is LIFO. So, oldest inventory price. Okay. LIFO,
196.
closing. So, closing stock will be at oldest price. Correct. Oldest price. How much? 64.
196.
196,100. Yeah, closing stock will be at oldest price. Issues are at latest price, of course. Closing stock is at with per price, oldest price. Correct. 58. FIFO perpetual. So, this 3600. First, we will take what? First, we will take perpetual. 3200. Balance 400 out of this. So, from this, how much continues? 3000 continues at the rate of 64.75. Then we purchased 3500. We purchased 3500. How much is purchased? 3500 at the rate of what? 66. Then while issuing this 3450, first we would have taken what? 3000. Balance 450 would have been taken out of this. Balance 450 would have been taken out of the next one. So balance will be 3050. Balance will be how much? 3050 at the rate of what? 66.
201.
2,01,300. Otherwise, inventory will be at latest price. Before method, the inventory will be at what price? Latest price. First in, first out periodic system, total cost of inventory of part number. This is a different one. It's a different question. Last in, first out periodic. What is the stock first? What is the stock first? 1400 plus 1800 minus 2000 minus 1500 plus 1400. What is the total stock? How much?
1,000.
Into oldest price.
318.
2 point. What is the answer? Repeat.
3,008.
3000.
185.
D. 3185. Now, what I request is pay attention. 60, 61, 62, 63. Till 69, I request you to work out. Till 69, I request you to work out at home. I try to request you to work out at home. Next session, I'll start with what? I'll start with which one? Question number 70 onwards, and we'll continue, where we will have discussion on investments, debt securities, and other things. From 70 onwards, we'll start on which one? Next session. Recording fixed assets, depreciation,